Your payment could quadruple, and millions of borrowers don't realize it yet. A federal court just erased the plan keeping payments low. Here's how a $108 payment becomes $466. If your monthly bills suddenly quadrupled, could you absorb it? Not cut Netflix, not eat out less. I mean absorb it without debt. Because for 7 million Americans, that bill is about to arrive, and most of them don't even realize how big it's going to be. And here's the part nobody's saying out loud. This isn't a penalty, it's completely legal. A federal court just killed the Save Student Loan Repayment Plan. Quietly. No dramatic announcement, no countdown clock. But within the next 60 to 90 days, millions of borrowers will be forced into repayment plans that could triple or quadruple their monthly bill. And what happens next is going to expose something much bigger than student loans. In the next few minutes, I'm going to show you exactly how much payments could jump, why millions are financially unprepared, and the mistake that turns this into a long-term wealth drain. Because this isn't just about loans, it's about how fragile most financial stability really is. Let me introduce you to Logan. He's 31, State University, business degree, $42,000 in federal loans. Normal story. When payments resumed after the pandemic, he enrolled in Save. His monthly payment, $108. Tight, but manageable. Then he got a raise, from $52,000 to $61,000. He upgraded his apartment, renewed his car lease, started breathing a little easier. Not irresponsible, just normal. Rent, $1,450. Car, $389. Insurance, $180. Credit cards, $3,200 balance. He wasn't overspending, he was living exactly at his income level. And that's where the trap begins. Last week, the 8th Circuit Court of Appeals vacated the SAVE plan. Gone. The payment formula? Gone. The accelerated forgiveness? Gone. The affordability cap? Gone. And Logan doesn't fully realize what that means yet, because when the notice arrives, his $108 payment won't exist anymore. Under most alternatives, his new payment could land between $380 and $480. That's not an increase, that's a shock. But here's what makes this worse. It's not just Logan, it's millions of people who adjusted their lives around that lower number, and now the baseline is being reset. Under SAVE, payments were capped at 5% of discretionary income for undergrad loans, after protecting income up to 225% of the poverty line. That protection was the key. It kept payments low. Now, under income-based repayment, payments jump to 10%, less income shielded, higher bill. And if someone is automatically placed into the standard 10-year plan, a $42,000 loan at 6% interest equals roughly $466 per month. Let that sit for a second. $466. That's over $5,000 per year after taxes. For many borrowers, that's their entire annual savings rate. Gone. And here's the quiet multiplier effect. During the 18-month legal limbo, many borrowers got raises, so when payments restart, they're calculated at the higher salary. Higher income, less generous formula, no transition cushion. That combination is brutal, but the real damage isn't the monthly payment, it's what this does long-term. Under SAVE, some borrowers would have seen forgiveness in 10 to 20 years. Now, most alternatives push forgiveness to 25 or even 30 years. If you're 31 today, that means you're carrying student debt into your late 50s. Think about that. Every major life decision now happens under that shadow. Buying a home, changing careers, starting a business, retirement contributions. The loan doesn't just sit there, it shapes everything. And here's the part that's uncomfortable. Many borrowers knew SAVE was legally challenged. They knew it wasn't guaranteed, but almost no one prepared. Why? 2 words. Present bias. When payments dropped to 0 during forbearance, that 0 became normal. The brain adapts fast. Money that was once reserved for loans gets absorbed into life. Slightly better apartment, slightly newer car, slightly less stress. Not reckless spending, lifestyle recalibration. And once your life adjusts upward, it's incredibly painful to adjust downward. Add optimism bias to that. Something will work out. The courts won't strike it down. There will be another plan. But now the ruling is final. Hope is not a repayment strategy. This is bigger than SAVE. This is what happens anytime people build their lives around a temporary financial advantage. Intro mortgage rates, employer benefits, tax credits. government programs. They feel permanent until they aren't. The financially stable aren't the ones who avoid disruptions. They're the ones who assume favorable conditions can disappear. Logan has 60 days. He can run the real numbers, use the loan simulator, choose a plan deliberately, adjust before the shock hits. Or he can wait for the default option, and if the default is the standard plan, that's when the silent tax really begins. Because the system won't call it a penalty, it will call it repayment. But for millions, it will feel like a pay cut. But here's the question nobody wants to sit with. If wages get taxed the second you earn them, and billionaires can grow their wealth for years without triggering a tax bill, is that a loophole? Or is that the system working exactly as designed? Because once you understand how unrealized gains work, once you understand how borrowing against assets replaces income, you start to realize something bigger. This isn't just about one billionaire, it's about two completely different tax realities. One for people who earn, one for people who own. And here's where it gets even more uncomfortable. There's a proposal on the table that could completely change this, a true wealth tax. Supporters say it would finally close the gap. Critics say it would break investment, crash markets, and hurt retirement accounts. So what actually happens if a wealth tax passes? Would it really make billionaires pay, or would it hit everyone else in ways no one is talking about? That's what I break down in the next video, because once you see how that policy would actually work in real life, you may rethink this entire debate. And trust me, the trade-offs are not what you think. Click here to watch it. Subscribe.